Focus. Ideate. Innovate. Enable.
Hello and welcome Hyderabad. We're here as Yes Securities presents to you the investor camp from here in Hyderabad. Remember, Hyderabad is known for its food as well as for its film industry, but today we're going to give you an essential component. That's some kind of investment in equity markets. And to address all of that, we have with us our three elegant speakers. So let's kickstart the show calling on our first speaker for this event.
My idea and focus today is to share a part of technique which we use regularly for determining what I would say is, for me, a long-term kind of scenario which is ending beyond 24 months. Of course, we can argue on individual definitions. Basically, we also work on charts with different time frames. So here I would be working on the monthly time frame chart. Just a basic ground rule which I want to set over here. What I've used is, I've used a trend signal, a short-term moving average, which is a 5-period moving average, and a crossover with the 5-period moving average of a 13-period moving average. These are all done on the monthly charts. I've also used the MACD indicator, as I said. I've used the 821 parameters, which is not very important for you to understand right now. So some basic ground rules as to how to understand and interpret long-term charts. The first rule is that if the 5-period average goes beyond the 13-period average, which means that the short-term average has moved above the medium or the longer-term average, we would construe that as some kind of a buy signal, right? And negative is obviously applicable. The basic rule too is that we've used MACD to understand if the momentum is expanding or contracting for the stock, alright, and the absolute value. So if the MACD goes up in a positive zone, the momentum is expanding on the upside, and vice versa. In the negative zone, if it's falling, the momentum is expanding on the downside, alright. And of course, there's one thing to remember. Since we are working on monthly charts, and we did talk about people looking at BTST as medium-term scenarios, I think these charts will have their own time frame for the signals to play out, right? So let's say if you are working on a daily chart or an hourly chart, if you take a position and you can have a pullback of an hour, you can have a breakout on the monthly chart and a pullback which could last for a month and more, all right? So what I'm trying to establish over here is a very simple mathematical way of looking at longer-term charts and understanding when the trend is on the positive or the negative side, and also combining that with the effect that when is the momentum expanding. So for people who want to buy and hold for a period of few months to about a couple of quarters, I think this setup, this combination of two signals will give you an excellent setup. You would want to be in stocks when the averages are in buy mode, and you would want to be in stocks when the MACD is rising, clearly suggesting that the momentum will expand on the upside. My personal experience, and despite being a chartist, I have a lot of respect for fundamental understanding of the stock, and I think that is a combination which will possibly see a lot of signals perform better. So we have seen buy signals happen in the last few years in infra companies not doing very well, but similarly buy in the last few years in the pharma companies do extremely well. Now obviously there is some kind of fundamental difference which is possibly aiding to the performance of the signal itself. So use that. I think I would like to quote Sherlock Holmes over here. When you're trying to deduct something, when you're trying to deduce something, make as many observations as possible, combine them and see what's the net result, and then try to work with that. Keep the basic idea of diversification. That is something which I've learned over time. While I do get signals on many of stocks, many of the charts, I don't put all my eggs in one basket. I would possibly want to have some kind of exposure spread across many stocks, so that some stocks which will do exceptionally well, a buy signal on a TVS, for example, did 1,000% return, while in Lupin did about 300% return. So you will be able to diversify yourself and therefore be able to manage your risk better. What I've done is that I've put few charts for you to visually understand the setup, and I've given a name of few stocks over here wherein the similar kind of setup is occurring. So on the positive side, other stocks which are showing such kind of setups would be Lakshmi Machine Works, Reliance Industries, Glenmark Pharma, Apollo Tyres, and tire stocks have been clearly, they've already started getting into the longer term buy mode. Apollo Tyres, Raymond. If you have missed Century has done extremely well in the last 3 months, going from 600 to about 900. Raymond is showing a very, very similar pattern. They both have very, very similar business models as well. MRF, Jain Irrigation, Prestige Estate, etc. And couple of stocks which are possibly showing signs of underperformance or contraction in momentum would be Bata, Ashok Leyland, Sundaram Fin, etc. They've got negatively biased monthly charts. As I said, thank you so much for your time. These are not recommendations but observations. And there's a disclaimer that in some of the stocks, I personally hold them, and our clients will also have positions over there. Thank you.
Keeping this weather check in mind, why should there be a need to invest in Indian equity? So, or at least if I may reframe the question, what is so special about Indian equity markets? Now, from an economy perspective, what you need to know is that India is one of the fastest major growing economies. Now, on a long-term basis, India outpaced the world economy in terms of GDP growth by an average of 3%. For the year 2016, the expectation is that this spread, this growth premium, will increase further to 4.5%. So from an average of 3% that we've used to in the long term, the spread now will increase further to almost 450 basis points. And there are other macros besides growth. So inflation in the post-global financial crisis period was at its peak of 11 to 12%. That is now successfully, I would say, reigned at a level of close to 5%. In fact, the way monsoons have been progressing, there is I would say there is a downside risk to even the 5.1% estimate that we've been putting out. Current account deficit, which we saw in 2013, became the sore point for the Indian economy, running at 4.7, 4.8%, is now down to almost 1.1% last year. For this year, we are expecting a deficit of 1.5%. Again, there is a downside risk to it, which means the actual number could be much better than 1.5% deficit. Fiscal deficit from its peak level of 6.5% in the post-global financial crisis period is now expected to be lowered to almost 3.5% for the current financial year. FX reserves. Now, FX reserves is something which the central bank holds, and this used to be at a level of $250 billion. That was the lowest that we've seen in the post-global financial crisis period. And this was in the year 2013 when we saw rupee depreciating by more than 20% in a span of just about 4 months. So from that period till now, the aggregation or the summation of FX reserves that has happened in a span of 3 years, in fact less than 3 years, has been more than $100 billion. So economically, if you see, most of my structural indicators are flashing green, at least the broad indicators. And in terms of the overall size, overall market, India is expected to be the 7th largest economy in the world. And it's just not the size of the economy, not just the size of the market. If you see, the earlier map was the GDP weighted map for the entire globe. Now, if you just convert that map into population weighted, so the entire picture changes. So almost 18% of the world population resides in India. Now that tells you the scope of market opportunity which is out there. And it is not just that it's the size of the market which is there. There is also a lot of inherent quality in this market. So on an average, an Indian's age is roughly about 28 to 29 years. So that makes India one of the, I would say, young countries in the world. And juxtapose that with the kind of income growth that we see on a nominal basis. So nominal GDP grows roughly around 10 to 12% on an average basis. So on an average, if an individual who's young and if he sees his income is growing at a rate of 10 to 12%, and if this individual size aggregated put together forms about 18% of the world population, then you can just imagine the kind of scale of opportunity which would be there. Now, I would just like to talk about 2 important economic reforms which have happened in the last 2 months. One is the notification of the inflation target for the central bank and the constitution of the Monetary Policy Committee, and the other one is the GST. Now, moving on from the reforms to taking an outlook on the Indian economy and some of the drivers that could possibly set as a driver for the equity markets. Now, for the Indian economy, for this particular financial year, we are expecting about 50 basis points improvement in GDP growth to about 8%. And there are few key drivers for that to fall in place. One is the extent of normal monsoon that we've seen. Now, as far as the last number is concerned, we were close to a 4 to 5% deficit. But in terms of official IMD's classification, the Met Department's classification, I think the monsoon performance is likely to be normal for the economy as a whole. There will be states which will be deficient, but at the same time, there will be states which probably will be receiving much more rainfall here. The 7th Pay Commission has already started doling out, and while a part of the allowances kitty will get implemented towards the end of the financial year, the other part is already implemented. And taking both together, taking the pay revision and the allowances together, the impact is likely to be huge. So we've seen that impact playing out with the unfolding of 5th Pay Commission, with the unfolding of 6th Pay Commission, and 7th Pay Commission is not going to be any different this time. For 2017, I guess it's very difficult to say whether the markets is actually pricing in any of that right now. China has been slowing down for the last 2 years, and that is something which is having an important impact, not only on global trade, it is having an important impact on global commodity markets. So a consistent slowing down of China's economy is something which is not to be taken very lightly. On the domestic side, most of the reforms that we've talked about are long-term in nature, are gestational in nature. So any short-term benefits are unlikely to accrue, but in the longer term, I think most of these sound economic reforms, talk about GST, talk about a monetary policy committee, inflation targeting, will be much more in the medium to long term. So I guess these are the factors which one should keep in mind. And for the year as a whole, I think happy investing and happy trading, all of you.
Well, I hope that session was knowledge enriching to all of you, but we'll slip into a short break. When we come back, we'll continue our focus on the markets, and we'll try to get you a lot of strategies when you're trading our Indian equity markets. Stay tuned. Welcome back. You're watching Yes Securities presented Investor Camp from here in Hyderabad. I hope the couple of sessions were quite knowledge enhancing to all of you, but we'll continue with our next speaker who's coming up for us.
There is, however, one area of the market which seems to be there all times. There are enough companies which keep on restructuring. So I am going to talk, my presentation is focused only on this one area called spin-offs. So what's a spin-off? A spin-off has two characteristics. One, there is an existing business hidden in a larger business. And for a variety of reasons, the main parent company has decided to take that business out and to separately list it. Now, there are companies which also go and do an IPO of that, in which case the benefits are somewhat subdued to the existing shareholders. But there will still be benefits because of what I will just explain in a little while. The best benefits come when they spin it off. And then the existing shareholders get the shares of the division, what was earlier a division, and you get it directly. Is this a phenomena which has not been discussed in investment literature? The answer is no. Unfortunately, most of the data we get relates to the US market. So here's a picture of what happens to spin-offs. This is a study done by JP Morgan. From 2009 to 15, there was a large number of spin-offs which happened where they have calculated the return. The interesting thing is, the starting point is when you announced the spin-off. So there is no prior information you require, right? It is not as if I need to be an insider to understand. Like I said, my assumption is that all of us are doing other businesses and investing is something that you do with your surplus cash. So I don't have the time to figure out some inside dope from some company and try and make money out of that. So here's that company where you have been announced that there is going to be a spin-off. A spin-off takes a long time. You need a board approval, board has to agree or suggest, then it needs to go to the shareholders, you need a shareholders approval, so you have an EGM or an AGM. In India, you then need a High Court approval, then you need to go to the exchange and they get the stocks listed. It is a process which takes at least 12 to 18 months. So there is no hurry. If you wake up the next day and you missed it, a week later will do. There is no problem. The interesting thing is that in the first 200 days, the outperformance is what this graph is showing. So how do you calculate outperformance? You look at what the stock would have done with respect to the market, and the outperformance is defined as the excess over that. So if it is just beta times the market, that is not anything great. The market goes up, stock goes up. The question is that there is proof or there is evidence to suggest that there is outperformance over the next 200 days till the time that the company actually demerges, and then the outperformance continues after that. Now that's a very interesting part of it. Peter Lynch in his famous book had written that typically a management will not let go of a small company and get it listed if they have to go and rescue it again. That will look really silly, right? You've got a company, it's already a division in your group, you take it out and put it out, and then you find, look what, you know what, this company is not big enough to survive, it doesn't have enough money, it's not making enough, so you have to go and rescue it again. That will make the management look like fools. Most people don't want to look like fools, whatever else they do. So therefore, there is an understanding within the company, usually, that if there is a company which you are going to release out in the market, chances are they would have thought it through and that company will likely do well. Whatever the reason, and we are not particularly bothered about the reason, what we are looking at is, can you make money out of it? And the answer is that it seems to make you excellent returns. So to conclude my point, the thought I'd like to leave you with is that if you are looking at large cap investing in well-known companies, please use the mutual fund route. There are people out there who are paid to do the stuff and doing very well. If you want to do some work for yourself, for whatever reason you are excited about the area, don't just treat it as find a place where you think the chances of being right are good. A good example that Greenblatt gives in his book is, you go to a roadside dhaba and you order food. The chances are that you may get one dal tadka which is very good and the rest of the food is not so great. If you come to a good rated restaurant, let's say you come to Taj Krishna and order food, the chances are most things on the menu will be reasonably good. So if you can find that one place where the chances of success are higher, you are more likely to make money. My submission is that spin-offs is statistically shown to be one such area. So if you are a bit careful about whether or not your interests are aligned with the existing shareholders, this could be one thing which you could find yourself making some money on and still having the fun of investing on your own. Thank you.
Well, on that note, we'll slip into a short break, but coming up next, we'll get you a lot more talk on the markets. Welcome back then. You heard all our three panelists give out their views, but now it's your time, the audience really, to give us all your queries and we'll try to address all of them. Over to you.
Sir, from chartist point of view, how do you take care of something like stop losses which we have? How does a chart help you in that? Because the current scenario being it can go up and down, volatility is high in that situation.
This is a very common query, and to be very honest, last 2 weeks I have seen a lot of my positions also getting stopped out in the volatility. But the fact of the matter is that if you are a trader, an active trader like me, possibly you are doing some about 500 to about 1,000 trades a year or possibly sometimes even more, then in some cases it will happen that the stop losses will get hit, okay, and the stock will move up again. But in majority of the cases when the stop loss is hit, okay, it will possibly protect your capital. And people who are trading on leverage, capital protection is an extreme must in this market, in any market for that matter.
I have a question on, I understood the spin-offs, but does the fact that the Kane Vedanta merger, demerger, any theories on whether, such kind of, conglomerates getting back and, does that de-premium work in that case? Or defocus works?
So more than 70% of mergers don't work. By and large, most managements are incentivized to increase their span of control. And that doesn't necessarily make for good business, which is one of the reasons why demergers work, because you are reducing your span of control. No management wants to do it willingly. We are all people who hunger for power and influence. So to try and shrink a business requires certain incentives and a certain push, which need not necessarily come from the ego-boosting merger kind of business. This ratio I'm saying of 70% failure is not only for India, it is across the world. In fact, perhaps more so overseas. Most mergers don't work, most demergers do work.
Actually, I made some 20 to 25 lakh money in the stock market in the last 3 years. I want to invest that money in the stocks now. Okay? I want some sectors which can perform next 10 years. I am 29 now. I want to invest up to 40 years. Okay? I can put that money in hold also. So I'm looking at Bajaj Finance and Muthoot Finance in NBFC sector, and Axis Bank and S Bank in banking sector, and TCS in the IT sector. I don't know about much on pharma stocks, okay? So I'm requesting you, please guide me for the next 5 or 10 years to invest in the stocks.
See, every stock, if you look at, let's say, the 52-week high-low, will have at least a 30% range. The question is, does the value of a company change by 30%? The answer is no. So why does it change? I have no idea. I don't frankly care. The question is, if you can put a value to the stock, then when it comes to your price value, you buy it, otherwise you don't, right? To answer your specific question on, let's say, finance sector, what has changed in your mind over the last 12 months that a stock should go from, let's say, 2.5 times book value to 7 times book value? And what does that mean? Please understand, finance business or banking business is a business of leverage. You put in 10 rupees of equity, you take 190 rupees as deposit if you're a bank. If you're an NBFC, typically you will not get more than 50, 60 rupees. And you are supposed to make 1-2% spread on that damn thing. The maximum ROE that you can make, that is the earnings that you can make on your money, cannot usually exceed 18 to 20%. When you are buying it at 7 times book value, the yield that you are getting on it, therefore, is 1/7 of that. Which means your money for you is earning 3%. So you have to ask yourself the question that, whatever is the growth, if the maximum the company can earn, not grow, earn on its money is 20 rupees on a 100 rupee investment, and you are making 3% out of it, are you getting good value?
Well, to pull the curtains down on this fantastic event, I hope it's enriched you all in terms of knowledge. Make the right decisions, be patient as well, and I hope all this advice helps you all. So we'll sign off on that note. Till next time, stay invested, stay confident, and also be careful. Keep your stop loss whenever you're trading.
Focus. Ideate. Innovate. Enable.